Good evening, traders. Welcome to the Sunday Open. I'm your host, Craig Shapiro, macro strategist here at NinjaTrader Live. It is June 21st, and it is Father's Day. So happy Father's Day to everyone out there who's joining with us this evening. We really appreciate you being with us. I know that it is golf weekend. The U.S. Open is on. There's World Cup action. It's Father's Day, ton going on. But the markets are open, so we're here. And we're going to go through it all. It was a big week last week, a lot going on this week too. Just a quick look at the open, and I'll get to the panel. S&P is a little bit softer to start the week, down 13 handles to 75.44. NASDAQ down 70, 35.79. Russell down 34 basis points. Big mover, oil, not surprisingly, some scuttle over the weekend in Switzerland between the president and Iran. So we'll see if the deal that we signed, the MOU last week, actually can move forward or not. The Strait may or may not be open. We'll talk about that as well. Bonds are a little bit soft. The dollar is a little bit stronger. Big move in the dollar last week after the new Fed chair, Kevin Warsh, took the helm on Wednesday, and the committee has moved hawkish, and so we'll talk a little bit more about that as well. Joining me this weekend is Blake Morrow, the Pipsar. Thanks, Blake, for joining us. Pax is joining as well from Chicago, and a new member of the team for this week, at least, Samantha LaDuc, who joined me a couple weeks ago in the afternoon, and she's joining us from north of Boston, where apparently there's no more beer. It seems like beer has run out in Boston because of the World Cup action. So how's everybody doing on this Sunday evening?
We forget
Happy Father's Day, Craig.
Thanks, you too, guys.
Fellows, happy Father's Day.
Thank you, Samantha.
Thank you.
Happy Father's Day, boys.
Thank you.
Well,
and
thanks,
everybody in chat. Happy Father's Day to you all, too.
Well, last week was interesting. Big moves from the bond market, the dollar. We have a new Fed chair. That was kind of the big deal. It was also expiry week, which I think helped hold us together. We talk a lot about the flows every morning and every week as well. And so now a bunch of the supportive flows, the gamma positioning is kind of off the board. The window of potential weakness, as Jem Carson likes to call it, has reopened. And so cross asset signals, I think, are going to be a little bit more important this week. We had a big move in the dollar, as I mentioned, big move higher in yields. Half of the Fed's committee now is looking for a rate hike this year. 6 of the 18 members are looking for 2 or more rate hikes this year. 35% chance of a rate hike as early as the next meeting in July. So a lot to discuss. The elimination of forward guidance as well from the Fed chair. So the Fed's moving things, and we'll see if the equity market actually reacts. But I want to just start over with you, Blake, since FX was kind of the big mover and the dollar last week really started to shake the tree a bit. I'm curious how you're thinking about the setup for this week in the dollar. And how it might impact everything.
Well, first of all, I want to just say, Happy Father's Day to all the dads out there. Keep up the good work out there, gents. As far as the dollar goes, I'm really staring at the dollar index as a whole. You can see. Oh, here, I'm sorry, I was just looking at something else. So let me grab the dollar index for you guys. The dollar index is actually in a bull flag formation, and so overall it looks pretty bullish. And we are approaching a long-term 38% retracement. But most important thing about the dollar index right now is it is in breakout territory and it hasn't pulled back. There's a couple pairs that really have my attention. One of them is the Aussie. The Aussie is holding above 70 cents. It's a big figure number. It's also triangle support, but it's in a head and shoulder pattern. So it does look like it's going to eventually break down. But it's not going to do that without risk aversion, if you will. And so the market's still holding up really well. Obviously, the S&P futures right now are at 75.47, 25 bid, and so they're holding up overall. So that means the dollars shouldn't get too far away from us. But with this breakout in the dollar, we get much above like 101.30. You can see it's in teal here. It's also the 38% retracement. That should kind of unleash a little bit of dollar strength. And overall, when the dollar, you look at the dollar, and a lot of people like to look at the dollar and say, well, maybe it's U.S. exceptionalism. in this case, it might be a little bit of that, but I think this is more of a liquidity issue and a rates issue. So, as the dollar firms up, don't look at it as it's necessarily a good thing. It isn't always a good thing. If the dollar's strengthening in this environment when we're up at our highs, that means that it might put some downside pressure on risk. And as you pointed out, Craig, the market was held up by a few things, I think, last week, but now that we've gotten past, the options expiry, we've got a new Fed chair who's undoubtedly a little bit more hawkish than the market was expecting, hence the market reactions across the board, especially in the short end of the curve. I just think that the dollar looks at risk of continuation here. And if it does, that might not be necessarily a positive thing for risk appetite as a whole.
Yeah, no, that makes sense. But Pax, I'm curious, as you think of the setup into this week, for equities, we haven't talked a lot about the dollar as something that has been on your radar screen as a driver here. Do you suspect that you'll be looking at it more, or not necessarily, part of the playbook at this point yet?
No, I always look at it, and I called Blake on Friday when I was going after the close, when I was going to work out, just to kind of chat about the week and see what he said. And we talked a lot about the dollar, and I'm very interested in getting Samantha's thoughts on it too, as we were talking about before the show. But from a trading standpoint, I don't trade the dollar. It's not something I've ever learned to do, much to my detriment. I've learned how to trade the S&P against the bonds. I've learned how to trade the S&P and the NASDAQ against gold. But never against the dollar. So it's always best for me to keep things simple and focused on my process, so that I don't start to overthink things and start to take some macro based trades that I'm not going to fully understand all of the factors going into it. Now, when I do find myself positioned one way or the other, then I'm going to pay attention to the macro at that point. What's going on with the dollar? I'm short S&P, the dollar's spiking, gold's getting whacked. Bonds are selling off. Do I want to add, or do I want to my position, or do I want to turn around and flatten and take the money? When something like that is going, I'm more likely to add, but I'm not going to take a trade as a result of it, if that makes any sense, Craig. I need to keep things as, I'm Irish. I have to keep things simple. My Uncle Artie used to say that all the time. I'm Irish. Repeat it back to me. So, I keep it simple.
Yeah, no, it makes sense. Samantha, I think you say this, the dollar makes the weather, maybe. I forget. I think that's one of your coins, but I'm curious. How are you thinking about the dollar for this week and the implications for equities? I want to kind of transition into your outlook here for the equity market as we head into, I guess this is the second to last week of June.
Yes. So I do have a saying, the dollar makes the weather, and its rate of change determines its severity. So right now we have been in a sideways consolidation pattern for many, 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 many months, right? It stayed firm. It hasn't, taken off or fallen, which was, kind of a baseline for a lot of precious metal bulls. And then when I was on the show with you a week and a half ago, I said, I am dollar bullish. I'm also expecting USD JPY to get above that 161. And that combo factor is going to be bearish for gold. Also, if they do a yen intervention, and they've spent an enormous amount, 11, 12 trillion Japanese yen in intervening in the bond market in Japan to kind of lift a little bit of this political instrument that we know of called the yen. Didn't work at all. But while they have been doing this yen intervention, gold in particular and precious metals in general have been falling very strongly in April and in May. So here we are, new Fed chair, and the literal warning of my client post was in capital letters, watch the dollar, because it wasn't just that we were going to have potential for a hot print, meaning, hikes, pulled forward in the future from the committee, but also they have, as you saw, it was a hawkish hold, right? 9 of the 18 FOMC members expect a rate hike. You've already given chances for July, definitely end of year, but also the PC expectations were very hot. So, they came in almost a full percentage point since March higher. So and slightly lower GDP growth for 2026. So that dollar spike that we got post FOMC meeting was kind of a risk off warning. And I think it is starting. And also the dollar yen at the 161, really pivotal. That's when they have come in 2 years ago did the intervention also when we had that market unwind in July of 2024. So I think that this is a potential that is coming in to a theater near you where we have yen intervention, but it's having diminishing rate of return. We have Warsh coming in, seemingly hawkish, but I think he has a little other plan, which is to get negative real rates negative and stay negative, which is kind of stealth QE support. So I think we have to have this tussle going on between the macro and the currency market, which absolutely the dollar makes the weather. And now its rate of change, its speed at which it can run will impact everything else. So it can quickly turn to be a headwind for equities, especially when you combine it with rebalancing into the end of the month. But ultimately, I think we're going to have to wait with rebalancing into the end of the month. But ultimately, I think we're going to have to wait for the next shoe to drop in the energy crisis, which is the Iran war, for us to really have Fed rate hikes on the table.
Yeah.
Samantha,
Pax,
can you
go ahead,
repeat that
Pax.
real quick? What did we were talking about it earlier too, about Warsh. Warsh is going to force kind of a QE on us with negative real yields, right?
Mm-hmm, mm-hmm.
Yeah, that's so smart and such a great observation.
That's mine. I mean, he's removed forward guidance, right? No transparency. He's moved the goalposts on inflation, threatened to. He's also bringing in outsiders, and some might think that's good. But if they're Project 2025 focused, it might be also why the dollar is spiking on reduced Fed independence. He'll get some committees in place. And he's, by the way, the breaker of the vote. In other words, if they have a tie, he gets to break, he gets to choose. So there's a lot that's going on with the Fed independence that can also impact the rise of the dollar.
Wow. 20 Agenda 2025. That's great. This is really interesting. Really, really good.
But the market likes it. The market still interprets the task force coming in and the QE potential and the Fed rate cuts and the falling energy prices. All of that stuff is still getting priced into the concentration risk of AI. And now we have Micron earnings Wednesday after hours, and everyone's already long. So this is actually my expectation. We kind of went into Avgo and Sienna and a few others that were in the AI trade a few weeks ago. Literally June 1st marked a short-term top. We had some dispersion unwind. I think we're going to get that again because everyone is long Micron.
Mm-hmm.
Yeah. And Micron's the big name for this week. Reports after the close on Wednesday. But back to you, Pax. Just we're a little bit more than a soggy open at this point now. Curious, what are the levels you're looking at here for S&Ps? How are you thinking about the equity market for this week? We threw a lot at the tape last week. Obviously, the week before we had the SpaceX IPO. Last week with the expiry, we had the Fed meeting. Equities have kind of held together, but on the hopium trade of the Iran deal, kind of walk in today a little bit softer than I think maybe folks expected. The back and forth with the Iran stuff, but oil's up 1.6%. The dollar is a little bit bid. Bonds are selling off a touch. How are you thinking about the levels for S&Ps?
I've never seen a bid that I haven't wanted to hit in my life. So I'm either going I'm going to wait until I think this is kind of a bearish open. So I'd want to be short against the opening print at 75.43 and change whatever that is. But if the S&P can get under 75.08, I will sell them aggressively. It opens up. We're going to have a very, very busy summer. The third quarter is going to be really, really, really good trading. NASDAQ corresponding price is 30,263. If the NASDAQ gets under 30,263, then I'll be short. And I'll be short aggressively. I don't know if I'll be short NASDAQ, but I will be short S&P. I try not to trade NASDAQ anymore. But until then, traders, you guys can look to take a wiggle against the opening print and against the overnight high, which is what's the overnight high? 73.5. You can look to take a little bit of a short there. But in the meanwhile, wait for the setup tomorrow And when we get it with RTH, if we turn around and start to rally above the opening range, then you can get long a little bit and look for those rotations. But for the most part, I'm a sell the rally guy at this point, and underneath 75.08, the next level is going to be 74.5. Underneath 74.5, then it's going to be a long way down. Well, 74 even, and and then another 200 points until we get down to really 67.96, so 6,800.
Pax, when you like talk technicals, like just technical structure. Remember when you and I talked over the phone on Friday, and we talked about last week's like midweek lows, right around the FOMC, well, right through the FOMC. Mm-hmm. The spike low actually resides at a 38% retracement of June 10th's low to the high from earlier last week. I guess it was on the 15th. So that spike low is basically the 38% retracement. So if we breach last week's lows, that's where you think about like bulls and bears and bullish setups. Usually what constitutes some sort of bullish setup is a shallow retracement. So when you get something below a 38% retracement, which happens to be last week's lows, that's when bulls say, you know what, I don't want to be long anymore. So then you're really opening up some downside below there.
Yeah. So 100%. So if we take out 75, what was the low? 74.
74.60 something.
Yeah, 74.72, I think.
That's correct.
If we take out we take out 74.72, I'll already be short from 75.08. I'll take some off the table there, and when we get under there, then I'm going to sell them, take more off at 75.5. We get under there, sell more, and then I'm looking for 74, like 74.06. But that's the trade plan. It's to be and to be flat in here. There's really nothing for me in this general area that we're trading. But man, we get under that level, then that'll be the trade. And if we can get below 74.72 last week's low, then like Sarah would tell us, then we've got all new capital flow underneath there. So I'll already be short and I'll be taking profit to everybody that'll be selling them, and then take them lower. And same thing in the NASDAQ, by the way. It's the same setup.
And when you start talking like 6,700, people look at that and they're like, man, it is so far away. But if you look at the just like longer term, and I'm going to just zoom us out a bit.
Have to.
Yeah, this is a channel we've been respecting all the way from 2018. We get back below those lows from 7,200 or 72 and a quarter, wherever it was from 2 weeks ago. That's when you have like a false breakout. You have the technical structure. A lot of people call it a throwover. Some people call it a slingshot. I just call it a false breakout. And then you got everybody trapped at the highs. And that's when it really, you start to look at like, what's the rest of the summer going to shape up to look like? And that's where 6,700 doesn't look so far away.
Right. It really isn't.
Yeah,
it really isn't. That doesn't mean that we don't turn around, that we hold 75.08, and then we don't turn around and start to rally up to 79.65 or 8,000. We crazier. Well, I mean, just take a look at that. Look at that chart that we have up on the screen. I mean, look at that crazy rally that we've had off the lows. The 65.53 was the low 2 months ago, or
right,
however long that was. But I mean, that's just craziness. To think that we can sustain that bid. But then again, stranger things have happened. March 30th, that was the low we made on March 30th. Just look at that crazy shit.
But we also had March 30th, the end of quarter pension rebalancing, and it was very positive. And we had short covering that triggered as a result the beginning of April. Then we had the April 8th Trump headline for ceasefire, which had us gap above the 200-day, the mosh pit of moving averages, and go. Then we had CTA buying, vol control funds, suppressing volatility. We had the oil futures market highly manipulated with insider trading, right? So there was, and then we finally had retail join in. So we definitely had a rally for the ages plus AI, and we can still move higher. This is true. But not with a dollar that's rising. That's definitely a short-term headwind.
Right. What did you call the 200-day, the mosh pit of what?
No, it was every moving average. If you look on any daily chart, we gapped up on April 8th with that headline of ceasefire, right? And it went above the 200-day, but it was also the mosh pit of all moving averages. I don't care what you use,
That's
55.
great.
It doesn't matter. They were all below as we jumped above and stuck that landing. So then, of course, we had a little dispersion unwind the first week of June, and now I think we're going to have a little bit of a summer storm. But ultimately, we have another reason why the market can go higher, not just the negative real rates that I talked about with a wash, effect. And that is definitely, I think, his goal. But also, you have a situation where you've got yield chasers, and they really are not looking at, the oil crisis that could be in the future. It won't happen until it's here physically and they can feel it, right? So you also have a situation where you have slow hiking schedule, because right now, again, rate hikes are also very detrimental to duration trades. So you got what, 4% on the 10-year roughly. You can buy the S&P at 3.7% yield. That is a reflation trade that yield chasers will buy every day. So I know that's a kind of a more fixed income focus, but the point is, if they're not expecting an energy crisis until midterms, they're not expecting the rate hikes until we have an energy crisis, then they could absolutely build this thing up in a melt up. But first, we need to go through a little bit more, I think, unwind end of month rebalancing.
Hey, Craig, Treasury Secretary Bessent, he's got to shill out some 2s, 5s, and 7s.
Yeah.
Yeah.
But what I was going to say is it's 250-year celebration, July 4th. You don't think it's going to be new high on the 4th of July? I mean, come on, let's get it up there. But one thing we do talk about all the time is the flows, and there's been a lot of talk in the Twitter sphere last couple of days about kind of record pension rebalancing for quarter end, given the outperformance of equities versus fixed income this month, and particularly this quarter, that we could have record equity for sale on June 30th or the early part of July. And so to your point, Samantha, kind of the opposite of what we saw at the end of March.
Yes, correct.
And so we've at that point, I so vividly remember Anthony mentioning on March 30th how we were kind of, NASDAQ was 3 standard deviations below the year-to-date VWAP, and how that, was kind of historic in his mind, and what a great call, and, kind of getting along there. I think we're pretty elevated now, and we have all the flows kind of looking the other way, right? CTAs are long, retail is long, pensions, everybody's long, call buying, FOMO is in. And so, now that you have this window of potential weakness reopened, you have, cross asset traders and other folks who look at the dollar more closely and that implication on the economy and on asset prices, those who are looking at the rates market, particularly short-term rates markets, and moving, those yields moving higher, hikes being priced in. We had a massive curve flattener over the course of last week, which has unwound a lot of steepener trades, which people have had on all year. And so, we're in a period here where those flows are going to matter more. Right now, broadly, we're in positive gamma, but we know as we start to move lower, if we start to move lower, we could quickly cascade into more of a negative gamma regime into that quarter end dynamic with the pension rebalance. So. But a lot going on this week with those auctions. We also have those Micron numbers on Wednesday. We have what else do we have? We have the flash PMI on Tuesday, and then importantly, core PCE on Thursday. Even though we know, we broadly know, 75 to 80% with 80% chance of the number, you just look to get a hot, reading there. And for a new Fed chair who wants to be more data dependent, if we have another hot PCE print, we're only going to get one more inflation print between, one more CPI print before the next meeting. If this PCE print comes in hot, it's going to be very difficult for folks to not think that the odds of a rate hike for the next meeting are going to move even higher. Right now, 35%, but I can see them very easily going above 50%. I mean, if he's going to hike, why not just hike now? Right. I mean, now is when, the pressure is there. When more of the committee wants to do it. If you think that the economy is too hot and we want to bring inflation back to target, and you want to have credibility later with more members on the committee. And clearly,
Yep.
Warsh is coming in without necessarily a lot of friends on the committee and a lot of credibility. He needs to do a lot to eventually get people on his side. Moving sooner probably would make a bit more sense. So,
Do you want the
we'll
committee
see.
on your side, or do you want President Trump on your side?
Yeah, look, I think
do you want credibility? Do you want credibility, or do you want headlines?
Do you want to you want to get the shit kicked out of you
I mean, he's got the job already. So, it's going to be very difficult for him to be replaced. In order for him to move at least, 9 members of the committee, he's going to have to show them that he's on their side when, things are averse, such that when things move in the direction of cuts, they'll say, yeah, it's time. You're right. And so it is.
Let's see what happens with labor data too, because I can see absolutely a case for a normative cut in July. Not popular, but I actually had that earlier at the beginning of the year. So this is something where I think they could do a normative cut in July and then an accommodative one toward the end of the year, should we get some energy crisis brewing again, which is a real risk. So
you mean a hike? You mean a hike, not a cut?
Hike.
Right?
Did I say cut? Oh my God. Yeah. No, sorry. July hike and a normative and then accommodative one toward the end of the year because of inventory drawdowns. I mean, we're talking serious. SPR levels 1983, right? US is now going to be a forced buyer toward the fall. You got OECD reserves very much drawn down, et cetera. There's no lack of energy risk coming in to the future, but also the fact that we've got Bank of Japan also has their July meeting, and they have a Fed problem. Bank of Japan has a Fed problem. They did their normative hike, this past June, but they have a bigger issue as it relates to energy costs. Yeah. So wouldn't be surprised if they kind of do a little bit of coordination there. But I wanted to show you the dollar, if that's my little view anyway of this chart. If I can show you real quick.
Yep.
Let me know.
Yeah, you're good.
I got it. Okay. So, here is this dollar on a weekly standpoint, and it's got just a gorgeous little scoop pattern. I know everyone is hyper focused on a very small time frame, but big picture, that's the dollar. And you were just talking about returns in tech land, right? Micron being bellwether for absolute sure. And it's got a 1,500 price target by, Stifel last week. And they're still swinging for the fences there with calls galore. And I can show you where they're absolutely all long in Micron. But right now, options market are also, this is Apollo, bracing for this tech shakeout. There is just a little bit too much. You know how I say outliers also revert with velocity. That was my theme for June 1st, that first week of June when we had a dispersion unwind. So I can see another case of that because we're just getting, the market right now is a little more fragile because of this concentration risk in growth stocks while the overall S&P volatility stays relatively calm. That's a chart from Apollo. This is one, and I forget, Bianco, he's been showing that, you strip out the AI contingency and you got flat year-to-date market.
Yes.
And then we have this AI ramp outsized returns that did have a little alley-oop into the first part of June before Trump came out again, right? With we've got an MOU coming up. So the point is, right now it's very headline driven. But if I may, just real quick, when I said Micron is actually everyone is long, which is why it's not so exciting for me right now with Micron. You can kind of see that there, if I put premium paid on Micron, this is a tool that I actually have, and you can check it out, option-teller.io. You can see premium paid, massive bullish bets coming in, but also lots of puts sold. So for me, that's kind of as good as it gets when it comes to some of these earnings plays that are coming up into focus. And once you clear that event, then you typically have a market that can go into digestion. So that's baseline bet what I'm looking for.
I mean, Micron's up 260% from the March lows. I mean, if you're chasing it higher here, I mean, you're asking for problems. I mean,
big bulls. They're all long.
So. Yeah, I mean, yeah. Anyway, Wednesday should be interesting, and how it trades after Wednesday is going to be really interesting.
Yeah, for sure. Well, we're about a half hour in here, and thanks for everyone who's been joining us. Chat. If you have any questions, just post them in there. Definitely send some likes our way. Really appreciate it. But again, a soggy open. S&P's down 40 basis points, 75.40. Russell down 57 basis points. The NASDAQ, 58 basis points. Gold a touch softer, the dollar a bit stronger. I think we kind of, someone asked in chat about the gold move. We'll talk a little bit more about the gold move in a second, but I wanted to mention the oil price here, 77.61, up, nearly 2% or 1.5%. So, and December crude also. So, Blake, your thoughts on crude here? Maybe to throw up the crude chart. Part of the hopium trade and getting yields down was the oil price, which, the peace trade. Oil really had some negative price momentum in the early part of last week, even kind of ahead of the MOU. And then really, I don't know, did we wash it out? It's going to stabilize. It's starting to move back higher again. I mean, the Strait, as Tracy likes to say, the Strait's still closed. I think she's right, because it doesn't seem like things are really, moving so rapidly out of there. But what are you seeing here on the oil price?
Well, okay, so Tracy and you and myself, we had this conversation. It wasn't last Friday, it was the Friday before last, right? We're just waiting for a shakeout below $80. Cracked out those lows, get everybody short. Notice how we respected and we created a hammer off the 200 DMA. That was actually on Thursday. Friday, Thursday, we stabilized there. Friday, we created a hammer. And today, we're gapping up and we get much above $79. Then you're going to trap the entire market on the short side. And as we were saying a week and a half ago, let it clear out all the longs, let people get short, let people believe, Trump says that, gas prices are going to come down rapidly. Crude oil is going to come down rapidly following the MOU. And, I still believe that there is going to be a supply issue. Tracy and I have had those conversations. I know you and Tracy have had extensive conversations about this. And I think, we get back above 79, $80, we're going to be squeezing into next week. And that's not a good sign for anything, for risk or anything. So, it looks good. I mean, I'm still laser focused on this level, right? Whoops, let me move that red line right here. The previous breakdown point comes in at $79 on the continuous contract. So we get above that, it's squeeze city, and I like it to the long side, frankly, as long as we're above the 200 DMA. That's something we've been talking about for the last couple of days.
Yeah. Pax, any key levels for you here in crude? Any
77.70 is a long, if you draw a horizontal line, if all of you draw a horizontal line going back 20 years.
I'm doing it.
It is, you look at it, it's incredibly pivotal. So, from a trading standpoint, I want to be long crude, but from a trading standpoint, you can take a short there, and then you're looking for the 200-day down at 75.05 is the price, but 75 like 15, a little bit in front of it. And then if we get under the 200-day, then you're looking at last week's low. I think it was last week's low, like 73.60, 73 double.
There's that 77 level that you're talking about, how pivotal it has been for so many years. I mean, it is, you can
forever.
Forever.
Yeah. Well, old lows, old highs. Can you put Blake's chart up real quick?
Oh, it's up.
Oh, I'm sorry.
Yeah. It's up. It's up. So you can see exactly what Pax is talking about.
Yeah. So, I mean, that's a huge level. Once we get above there, then I want to be long. But right now it's just, from either a nothing trade or a small short. And then if we start taking that price out on the upside, it's awfully hard to really want to be short crude here, except for the president's sentiments. We're heading into the summer, and, that's going to firm price up, or who knows what's going on in with Iran, and the Strait of Hormuz is, as Tracy likes to say, is still closed.
And the reserves, how low are reserves, Craig? I know you guys talk about it daily, right?
Right. Yeah. Look, I mean, even the president himself mentioned kind of the idea that we're 4 weeks away, or from reserves being kind of at tank bottoms, and the functionality of the reserves being really in the trouble zone here. So look, I mean, this is the reason why he's so adamant that he doesn't want to continue this war. He is obviously hypersensitive to the oil price. He's done a reasonably good job of bringing the oil price back down. Over the course of the last several weeks. I mean, we're certainly, materially lower than those spike highs from March. And, he'd gladly tell you he thought it was going to be double that the pricing, and so he's patting himself on the back a bit. But we're stabilizing here in levels that really are not great for the rest of the economy, right? We've talked about how the AI trade and the AI capex really, the oil price is really not such a big driver, but for the rest of the economy, it is. And so we've seen the weakened consumer, weakened small business, the housing market continues to be soft, and elevated energy prices are a part of that. And so given the polling data, given the midterms coming, the president's doing whatever he can to try to bring the oil price down further from here. We'll see. Samantha, how are you thinking about the oil price targets and setup here in the next, little bit, but then also more structurally?
Pax likes my one-liners, so I've got one for you. There are better things to trade. So oil to me has already had inventory basically released so that the real economy hasn't been hurt yet. Once that, and 400 million barrels, I think it was, is a lot. So that's the ballast that we needed, that also gave this amazing, robust trade to the AI data center build out and CAPEX and the rest, right? We're at peak buybacks, by the way, with those hyperscalers. So we've got some other things to worry about. But energy cost, I think, will come back, no question, later. And so right now we're just kind of in that la la land or that sweet spot, but we also have massive headline intervention. It's really like we were talking about the yen intervention. When did they do it? They did it on a Friday night when Japan was sleeping. And if you're not in front of your computer, US, you're going to miss it too. So I think the headline risks, the futures manipulation, and the energy deficits that we're going to have to deal with in the fall will be very front and center. But right now, they're just better things to trade. And I think, we've already talked about rising dollar. Currency is very important. It's kind of front and center right now for me. Headwinds of higher yields, not when you have oil falling from this supposed embargo release. So bonds right now are going a big sideways. Could they get bid? It hasn't been a safety trade, right? Dollar has. So I think we can still have some summer storms, but as it relates to oil, no. I like refiner margins. I like refiners as a swing continuation trade, Valero and PBF and the like. I think refiners, even before hurricane season, are printing money. So there are some individual plays within the energy sector as stocks. And since I'm an options trader, I'm kind of more focused on that. So basically, I think there are other things to trade versus oil itself. Long story short.
Yeah, look, I mean, the story for it's all, there's still a big correlation trade here. I mean, in oil, in order to get the rate cuts, in order to get what the president wants, oil really needs to fall in order to take more of that heat off of the inflation market. And so I'm just looking at December crude, up at $74. I mean, we're still, back in February, we were low 60s, right? And so we're 20% above where we were in February before the war. And these prices are sticky. Obviously, they're off the highs, but the only way we're going to get rate cuts and real bond market strength and real fixed income strength is with oil moving materially lower. And it doesn't really appear like we're going to get a very easy resolution between Israel and Lebanon. It doesn't really seem like Iran is in any desire to remove their negotiating power by kind of dialing up and dialing down the velocity with which ships move in the Strait of Hormuz. So I think we're going to continue to just kind of be in a, sticky oil market that really doesn't show enough momentum to the downside to allow the Fed to, or at least the president to get what he wants, which is lower interest rates. So a very tough setup there for him.
Doesn't it feel like Israel is like that? Imagine like two boxers in a ring, and then the referee comes in and is like, the round is over, and he's trying to separate the fighters, and Israel is like that fighter that just keeps like throwing punches even though the round is over. Doesn't it feel that way?
Yeah. Look, there's some existential issues that Israel is dealing with here, and they would like to see the job finished. And there's obviously folks in America and folks on the in the administration who would like to have seen the job finished. But the president has very adamantly said that he did not want to become Herbert Hoover and put us through a depression in the economy, in the oil market, in the stock market by continuing this war. And so he wants to move on, but Israel's not looking to really move on. So this is a problem that we're dealing with here.
That's an interesting point too, because if he doesn't want to be another Hoover, if he is another Hoover, he will also be the president that is responsible for the dollar losing reserve currency status in that case. And then what?
Yeah.
And he doesn't want to be that way.
Every time the dollar drops strongly, he raises tariffs, whether he has the constitutional power to do so or not. So he loves the falling dollar because it also makes objects appear taller, right? So the equity market loves it. Your car, your house, things basically that wealth holders own. That's why he says he loves inflation, but wage earners not so much. So we definitely have productivity promises on AI, and Warsh is banking on it too. They haven't come to fruition because it's just too dang early. In the meantime, this is still an inflationary backdrop. If oil was to drop precipitously, either from a deflation scare or substitutes, right? Real legitimate substitutes, EV cars and the rest, which they have done over in China and in Europe and South America now too, then we'd have an economic stimulus. So he talks about falling oil, but really what's the replacement here stateside? We've got some issues with that. In the meantime, we have Iran war is still not priced in. And there's no part of me that actually believes that Trump is done. I think this is definitely just a short-term ruse before the midterm, and then the day after, be more aggression.
QE, that's more QE. That's more hidden QE. Some more. Sorry, you're 100% right. He's gonna save the. He's gonna try to save the midterms, and then who knows what.
Yeah.
And what you're pointing out, Samantha, as far as like the basing pattern of the dollar index, I mean, a lot of us in currency land are looking at this descending channel. That puts the dollar index at 107.
I got 105.
Yeah, I mean, 105 is here. You get up to 107, you overshoot, which currency markets tend to overshoot quite a bit.
They do. Mm-hmm.
And so us getting up to 107 is the euro trading around 108. I mean, and that puts a lot of pressure on everything.
Yes, it does.
Class.
Well, that is non-bullish.
No,
that's non-bullish. We're not there yet, but
right.
It's something to be on the lookout for. What are the macro triggers that will interrupt the bullish flows that are clearly in the stock market? Private credit is kind of, watching a little nervously, and the bond market is flat as a pancake for the most part, waiting to see what Warsh is going to do. We've already talked about what I think is, the negative real interest rates, but also bank deregulation. You've seen banks run up into the Warsh FOMC, presentation there, right? He didn't talk about bank deregulation, but that is another way to stimulate the stock market. The trillions of reserves and such, and maybe a little bit more, loans that are out that are stimulative. So long story short, I think we'll see lots of ballast to the negative effect of dispersion unwind or yen weakness, whatever happens with energy in the future and rising dollar. I think we can still have some ballast that they'll try and come in, or the levers that they'll try and pull around bank deregulation and negative real interest rates to kind of juice the market some more.
Wanted to shift to gold because I think gold is something that everyone owns, or at least here, everyone owns some, and yet the price action has been horrible. And after last week, with the hawkish direction of the Fed, real rates actually moving higher, particularly in the front end of it, and oil got smacked. And weak again in the overnight session with a dollar bid. Pax, what are you were talking before the show about some levels in gold and kind of getting more negative here? But how are you thinking about the setup for gold here?
Well, from a trading standpoint, I really don't. I don't want to have anything on in here from a just from a short-term perspective. I want to see how gold is going to act with this dollar rally, and I want to see how gold is going to act with crude sort of finding its equilibrium. I think the more that crude hangs in at these prices, the more bearish that is long term for gold. And obviously, the more the dollar holds and rallies, the more bearish it is for gold. So I don't want to trade it. I can make a case for getting long against 4,100, but with a very tight stop and getting out of there quickly and reversing and getting short. If gold takes out 4,100, if gold takes out this old low, which also happened to be the 200-day moving average, and again, if you take a look at if you take a look at a longer term chart, and you just look at the 200-day moving average. Every time we traded down to it, gold bounced. Going back to 2023, every time we trade to it, it bounces, including back in May, in early May or mid May, when we came down to the 200 and we bounced again from it. Now it's 4,100. We took it out. We're below it for the first time since. Well, we're a little bit above it, but for the first time since 2023, we traded actively below the 200-day moving average. So I think that once we get below that mosh pit of moving averages, I want to get short underneath there. I don't want to trade it here. Underneath 4,100, I think gold is in big trouble, big trouble. Down to 30. Between 3,350 and 3,500, the technical level will be coming more around 3,500, but there could be some downswing down to like 3,350.
See, we talked about this a couple of weeks ago. Remember when it was traded, it just broke the 200 DMA, and we're like, man, this thing looks bearish. And back then, and I know 2 weeks is a long time.
24 is a 200 day. I'm sorry, the old 200 day was 4,100. I'm sorry. But
right, no, you're correct. But remember, we were like, if it trades below 4,000, it's going to trigger a bunch of stops. I mean, it just, everybody's got their orders perched around the 4,000 big figure level. 3,900 is a spike low if you go back to October of last year. So that's where things get really dicey, I would say, for anybody that's long. So for you to say, for it to get below 4,000, then it takes out 3,900, 4,000, 3,900. Yeah, I mean, how could we not trade back to 3,500 pretty quick?
Well, yeah.
It's like an elevator.
Well,
right?
I mean, this is the first time that we've traded since September of 23. It's the first time that we've traded significantly below the 200-day. 44.20. When we took it out last week, we traded straight down to that old low of 4,100. We took it out, made a new low, got back above it. All right, back up to 43.25. If we make it back to 43.25, you got to get short.
Yes.
That's it. If we make it back to 43.25, that's your line in the sand. If we get above 43.25, back to the 200-day moving average. But as Samantha was saying earlier, with the strength in the dollar, and you and I have talked about it many times on the show and offline. It's with the strength in the dollar, it's very difficult to want to be long gold.
Can I show you my chart, your 3,500, and also some option flow in that GLD? Is it possible?
Yeah, let's do it.
Okay. Because we talked about this actually on the show. So I was bullish dollar. USD/JPY was going to break that 161, and that's actually why I'm looking for the summer storm, is because of that action. But in gold, right, you've got what you just said, right? This huge trend line. I've got it on basically down here, which is a gap up. And this is an absolute magnet around that 3,500. But what I find really also interesting is the fact that you could see how we had a short-term bounce. We were talking about that prior to the FOMC meeting and the dollar moving higher. Now, if I go into and look to see what's going on with the largest ETF, can I show you a GLD ETF?
Absolutely.
Yeah. Okay, so here's GLD. This is all options. This is customer matching. What comes in? This is a 7-month look back, okay? And I just sorted by premium. The most premium is over 35 million. Very, very important because it's a lot of money. Also 18 million, another 15 million. And you can see puts are still getting bought. Now, when was this trade, put on? June 11th, June 15th, June 11th. For July, September. So there's some big money that is still coming in. This is just recently, literally June 11th. And they're very bearish gold in the short term. So until this turns around and becomes like a micron, right, where everyone's long, you kind of go with the flow.
Yeah, earlier in the year, or toward the end of last year, when we had the moves in silver and palladium and platinum, and gold was kind of getting dragged up into that, and we had that all the money was flowing into precious metals, and that really led to the blow off. And more recently, it's just as the money is flowing elsewhere, it's just the precious metal story is just getting left behind. And the narrative is challenged, at least for gold, because central banks are raising rates, right? I mean, whether it's the ECB is raised, the BOJ is raised, now 35% chance that the Fed's going to raise in July. So gold likes liquidity. Gold likes rate cuts, and so we're just not getting that dynamic in play. The global economy is holding on much stronger, I think, than folks believed was possible amidst the war and amidst the slowdown at the lower end of the K because of the AI story. So it makes it more difficult to find this narrative now for gold, which had really been in place with the deficit spending from the U.S. and Japan and all these other countries, the increase in deficit spending. Well, right now it's being kind of offset by the tightening cycle, so making it a bit more challenging. But
that plus the Strait of Hormuz became the focal point, right? So gold was a shiny thing, literally. Silver before that 16% drawdown in 2 days. Silver was 39%, shaking out all of the short duration, right? The last in, first out bulls. But then what took over was oil. So even though we had that little reflexive bounce, this is when the Iran bombs, started the Trump-Netanyahu, war, 28th of February. Oil took center stage. And so you also have governments that were selling their gold. Turkey, Russia, they have disruption, settlement of trade in gold, especially when energy crisis or infrastructure is getting bombed, is a thing. It's a negative headwind.
Well,
so
yeah, I'm sorry, I didn't want to interrupt. Well, I did want to interrupt, but I want to make a point to your point is that governments can't power their economies on gold or silver, which they've been acquiring for the last several years. So they have to sell that to buy crude, and which they've been doing. Yep.
And you can see the high, second high in gold. And then that was all oil, front and center. Pay attention to oil because now it matters more. So that was it. It's just this is still a bearish trade from what I can also see in option flow, long story short.
Yeah, and a lot of, and I know silver has kind of got the cold shoulder recently, but a lot of people try to figure out how is it that silver can make it back to the mid 50s. The big, that was the all-time high breakout was around the $55 level, $55 level. We can see it. Technically, we can reach it, and those levels are now doable. I mean, we're trading at what, $65 right now, spot.
Yep.
So I mean, we're 10, 12% away from seeing the big breakout point. Which if you're a precious metal hodler, which you should be, like I keep it in my which probably I'm sure a lot of you guys do. You keep it in your safe. I mean, this is the time that you got to be loading up. You got to be looking at these levels as very attractive. Whether you're buying silver, whether you're buying gold. This 30. Here's this $55 level in silver. We could very easily trade down there. And gold, as you guys were talking about earlier, around 3,500. I mean, why can't we see it? And why can't we be acquiring, at this big breakout point here in gold? And that's the time you want to actually be walking over to your I like my physical broker literally is a mile away. And when gold and silver are in demand, you can't get your hands on physical. This is the time
Are you
when
talking
you
about 3,500 level?
Yeah.
Yeah, Gundlach did an interview 1 week ago, and he said, "I will buy with both hands at 3,500."
No doubt. Me too.
And you got to be at 3,600.
And the corresponding price in silver is got to be down near between 55, like Blake said, 55 to the Hunt Brother high. Yeah. Well, even as low as the Hunt Brother high, wouldn't that be interesting if we can see that $50, $51, a little rundown, some stops being run down to $51, and I'll be running off to the broker too.
Right. I mean, and that's the time when nobody wants it. That's the time that you guys got to be looking to be acquiring it and putting in your
how
bids.
will miners react? Because ultimately, if we do have this, this is one of the reasons why we had such an outperformance in gold and silver miners the past 2 years, because price of energy was falling, and that's 40% of their operating margin. So it's a big tailwind for margin, for for metal mining margins. So basically now we need to get this under control so that they can get back in play too. It's not just the underlying, but it's actually energy costs are a huge reason for the season for these established miners. And by the way, this is another kind of great play once we get settled, probably more like Q3, Q4. But the point is, they will outperform in 2027, my firm opinion. Inflationary assets are the boomer stocks are the new inflationary assets, but miners in particular with their heavy production and lots of other, like the Ciscos and the Intels. One of the reasons I was bullish wasn't because of the AI per se. It was because they already had the people, the financing, the processes, in place. It's already incredibly hard to replace those assets. Miners fall into that camp, especially with the administration's view toward China.
Yeah, I just pulled up some charts, on GDX and GDXJ. You guys can see they're clearly coming into some pretty important levels. So, as Samantha's talking about.
Yeah. No,
but the bearish flow is still very, very clear. Just very, very clear right now. They're still under, distribution. So not consolidation, distribution. Big prints are still coming in, have not cleared, have not covered. We're talking very large. And that's what I look for is basically where the footprints are for where capital is deployed, bullish or bearish. And right now that precious metal sector is still out of play.
Yeah. Last look here. It's coming up on the top of the hour, and we have the crypto closeout coming up at 7 o'clock with Follis. And I'm going to hang around too to chat with him for a few minutes before we get to the guest later on. But S&Ps are a little bit softer, down 15 handles, 75, 42 last. The NASDAQ down at 83, 84, 30, 567. Oil up to 77.50. Gold flattish, I guess, right? Oil up, I mentioned that. Bonds are a little bit softer. We'll end on the Bitcoin, as Jim likes to call it. It also likes liquidity, and it's not getting it. And it's not been performing. But Blake,
do you mind if I start?
How does the Bitcoin chart look to you?
It's a bear flag and a bear flag and a bear flag, buddy. So, I mean, I don't know how else to explain it other than, and I know it's scary, especially if you guys are like crypto hodlers, which remember Wall Street, now that it's been, it's been woven into the fabric of Wall Street. It is Wall Street's, there are no hodlers, they're risk managers. And that's the thing that anybody that owns crypto, you just got to keep that in mind. It is a great trading vehicle, probably one of my favorite trading vehicles, but we have a bear flag, which the first bear flag target comes in at 52,000. That you guys, if you've listened to me for the last several months here, know that that's ultimately the problem. Is that what's happened over the last 4 months is this weekly bear flag pattern has developed that actually points to 20,000. I know that's a scary number, but I mean, it's not. It's someplace that we were at just a couple of years back, so it's not like like we're going to uncharted territory. But the 4-hour chart, which is a little bit more scary, well, in intraday, is we have a bear flag that points, to a lot lower levels as well. So it's a bear flag and a bear flag and a bear flag. So I don't have anything else to say about Bitcoin other than it's not very constructive if you're bullish right now.
Nope.
Samantha, final word to you on the Bitcoin here, right? What's your outlook?
Pax is going to love this. Better things to trade.
She's right.
Yeah,
absolutely. I don't want to look at it in any way, shape, or form going below 51 or 49. I couldn't agree more. And I see exactly what Blake is saying. I mean, I don't want to touch it.
Yeah. I mean, another asset class without a narrative, right? And so in a market that is trading narratives consistently and where money is chasing narratives, we had Ben Hunt on the morning show several weeks ago, and he talks about how important narratives have become, and you're really seeing that, right? We're seeing that in the options activity, we're seeing it in the call buying FOMO, consistently in these AI names. And, there are times episodically where that money shifts into thematic things, whether it's oil at the onset of war or silver at the beginning of the year or, Bitcoin at times. But once the narrative is gone, all the money, seems to leave. And when you don't have the support of the passive flows that the equity market has, it just, the asset classes the crypto asset class, it kind of falls by the wayside. So it's become more challenging for sure for crypto
Max, you want
traders.
I was just going to mention, you guys got to be on the lookout though for like, a lot of these names, and I've had some conversations with some folks recently about, just looking at some more obscure names that are, into whether you're talking about hyperscalers and or what do you call that?
Hyperliquid.
Hyperliquid. Thank you. I said
Hyperliquid.
hyperscaler. I don't know why I said that. But hyperliquid and some of those names, there are some really unique names that I think are going to provide some great long opportunities soon. And I'm going to, on this show or on one of our shows here on NinjaTrader Live, I'm going to start bringing up some different names of some that have got my attention.
Well, I have just the guy to chat with me about that coming up right now. So I want to just thank you all for joining me on the Sunday Open. Samantha, it was a pleasure having you with us, and Blake as well. And Pax, go enjoy dinner with the family. But now let's kick it over to Follis for the crypto closeout. Let's get cracking.
How you doing, Craig?
Hey, what's up, man? How's it going?
Not too bad. I've just about mentally recovered after hearing you guys trash talk BTC for the last 5-6 minutes.
And I've just mentally recovered from hearing my cat crying in the background as we were discussing how bad the gold market was. I mean, she was upset, and I'm upset
I was
too,
enjoying it.
I know she just was. We were trashing gold, and she doesn't like that, and because she knows I'm a long-term gold bull. And so she was crying, and I just could not stop it. And so we had to shift gears to something else. And unfortunately, we shifted from gold to Bitcoin. And then she, didn't mind it as much. But how's everything going, man?
She's bearish on Bitcoin. Yeah. So she kind of agreed with your analysis. No, I heard her in the background. Very cute. But that's awesome. Something like that. Yeah. It's going well, man. I mean, as best as can be done in a market like this. I mean, you guys kind of hit the nail on the head. It's a strange one where, we're analyzing this market and we're looking for, because there are opportunities in crypto all the time, but we're obviously like all the crypto natives, the hardcore crypto purists, of which I'm one, and Mercury, who is our guest today, is also one. We're kind of looking, with a little bit of FOMO, a little bit of jealousy at, the stock market, obviously like AI, tech, semiconductors, hyperscalers, and then even back in kind of like Q4 last year and even into January this year, we obviously had the big run on precious metals. So yeah, it's a strange time to be a crypto trader, I guess, but it's one of those things where, at this kind of moment of, I won't say capitulation, because I actually don't think we're there yet. But at this moment where people are losing interest and people are moving away to other markets, that's kind of where you need to have your eyes open and try and pay attention to the opportunities that might be coming your way. I think about previous bear market bottoms, right? And, it's really one of those things where people look at crypto as an asset class and they say all these things like, oh, it's a failed experiment. It's, it didn't live up to Satoshi's vision. She's full of scammers, full of grifters, et cetera, et cetera. And that's usually the sentiment bottom of the market. Now, do I think we're there yet? No, I think we have a little bit more to go. But I think back on people saying like, oh, sentiment has never been so bad. I'm like, guys, do you not remember 2022? Right? We had just come off FTX, Alameda, Luna. We had like Voyager, Celsius. There was like Binance FUD every week. There was, India FUD. There was China FUD. There was like Tether depegged. I remember everyone saying Tether was going to zero. That was kind of alarming, right? And then we had like the SEC was like coming for crypto. I mean, it was a very different scenario then to the kind of the macro environment we're trading in now. So I guess it's one of those things. Yeah, you just kind of have to have a positive outlook and try and see where the opportunities are rather than shutting off and saying, there's nothing here for me.
Yeah, look, I mean, it's like you want people to be trading what the asset class you're focused on. You want the money to be flowing in, but you also want to be able to do the fundamental work and kind of pick the winners and losers. It's kind of like this is the time where you could be fundamental, understand the good stories, the bad stories, such that that the capital flow dynamics are cyclical. And eventually the money will, flow back into some degree. and then you'll be in position to, you'll be rightly positioned at that point as the money starts to flow back in.
Right. And this is actually something I spoke about on last week's show, where I kind of think that this frothiness we're seeing in the tech market, in the AI market, like, I mean, you probably know much more about this than I do, but I think it's like only two sectors of the S&P have outperformed the index over the last like 4 years. It's like tech and communications, right? So to me, that speaks a little bit to potentially a bubble, right? And one that might give great opportunities for capital rotation if and when we get kind of a pullback. And I think that, again, this is something that you probably know a lot more about than I do, but the SpaceX IPO to me just screams kind of late stage cycle indicator, right? Where we're getting this froth, we're getting this, guys are taking out bank loans to buy shares in SpaceX. That to me says that we're closer to the end of this run than we are to the beginning of this run. And I think the incredible opportunity there is, we speak about it every time a market other than crypto is ripping, right? We go, oh yeah, capital will rotate into crypto. But I think the difference, let's say if we're talking about that capital rotation happening later this year, the difference is that BTC is potentially going to be trading at, 60, 50, maybe even as low as 40K, right? Whereas if you look back on kind of previous rips that we've had late last year, early this year, BTC was still trading like over 100K, right? And to me, that the value proposition there is not as clear as it is when BTC is potentially at a cycle low, right? Approaching these kind of like major macro support levels, approaching these kind of like 60, 70% drawdown levels from all-time high, which is traditionally, if you look back on previous cycles, where the market has bottomed. So I think that, this run that we're having in the stock market, it's going to create new millionaires. It's going to create new gamblers, new speculators, whatever you want to call them. And if and when tech gives a pullback, those guys are going to be looking for the next opportunity. And I think that BTC at 40K will present a kind of a very alluring value proposition.
Yeah, because I think at that point in time, the markets, the economy are going to be begging for liquidity, right? Part of the narrative for BTC is it does better when it starts to anticipate the liquidity coming in. And so right now with, markets at the highs, with inflation running above target, with a Fed that's more hawkish than not, central banks are raising rates. Historically, Bitcoin has not been a great asset when central banks are in hiking mode. When central banks transition back down to easing mode, whether it's to reflect, sluggishness in asset prices or certainly falling labor market or inflation that's moving lower, that's when BTC, does a lot better. And so we'll get there. We'll probably get there all at once, right? We'll have the capitulation, we'll have the tech trade unwinding, and we'll start finding ourselves seeing Bitcoin at levels that is attractive and stops making new lows or positive divergences at the lows. And so, but doesn't seem like we're there. Doesn't seem like we're there yet.
No, and I mean that's another thing. Like people talking about, I've never seen sentiment so bad. I've never seen the market so bad. I think it can get slightly worse. There's just a little bit too much positivity left in the kind of general market sentiment. But again, I just think back on 2022. It was really like I remember thinking, okay, like what am I going to do if crypto doesn't exist next year? It was really that kind of a thing. Whereas I don't think even now, I don't think we're anywhere close to that level of mass market capitulation. Nor do I kind of think that we're going to get there. I think that the big change this cycle, obviously compared to previous cycles, is institutional adoption. We saw that on a sovereign nation level. We saw that on a DAT level, institutions, treasury companies. And it kind of, even though we're still seeing this big drawdown from all-time high, and we're seeing, systemic risks with guys like Saylor and even Tom Lee top blasting Ethereum. I mean, this cycle has its characters as well, and plenty of top signals as well. But I think that the fundamental change here compared to 2022 is it no longer feels like crypto can be regulated out of existence. I think 2022 was the last cycle where that was the legitimate systemic risk. I think now the beauty of this administrative adoption, institutional adoption, is that there is kind of a hard-coded floor, at least with BTC. I'm not even talking about altcoins, because the vast majority of those, and I think this cycle has proved it, are just vaporware with an intrinsic value of approximately zero. But as you say, I mean, Bitcoin, once it starts getting down into the 40Ks, even like low 50Ks, it becomes extremely attractive as an investment. You're looking at the 4-year cycle. You're looking at this potentially being a cycle bottom, and you're looking at I'm not even talking about this kind of 10x, 20x return that we got in previous cycles, but even something like a 4 or 5x to bring us into the kind of 150, 160K region. Again, this is like 3-4 years away. But I think that starts becoming, quite a realistic prospect for many guys who've been paying attention to the charts.
Yeah. I am curious. You mentioned Saylor, and the market has this way of testing patience and testing positions. And is he and his MicroStrategy and all the different affiliated entities, is there systemic type of risk in the unwind, or has he put in a situation where at least Bitcoin, the asset class, is protected? What's your gut tell you on that?
So I think that two things can be true, right? And people like to talk in extremes when it comes to Saylor. I think that, it's a complicated issue. I think that time will largely vindicate Michael Saylor. I think that when we look back on all this low time frame kind of volatility, let's say, I think that on a long-term investment horizon, he will be vindicated. However, I think the short-term volatility and the short-term systemic risk that he's created was completely avoidable, actually. And I think that he has made quite a few mistakes in kind of establishing his position, if you want to call it, or establishing his place in crypto history. You talk about systemic risk. I mean, this guy owns like 4% of the total supply of the entire Bitcoin, which is nuts. And of course, it's a systemic risk. It's a systemic risk because one guy holds the key, right? And I'm sure there are safety measures in place, et cetera, et cetera. But the fact remains that one guy owns 4% of the supply. As for what this means for speculators, for speculative capital, risk on capital, watching from the sidelines as BTC slowly bleeds down and Saylor goes further and further into drawdown. I mean, there are so many competing theories that I see on my timeline. People saying that, the bear market won't bottom until Saylor gets liquidated. I don't think that's a thing. I think that Saylor's liquidation price is not really achievable. However, does that mean that he can't reach a level where he needs to start realizing it, like freeing up capital, liquidating his stocks? Probably not, actually. And I think that that's a legitimate concern, right? We saw that he sold, what was it, 32 BTC a couple of weeks back, right?
Yeah.
It's like the first ever sale, right? It was kind of his virgin sale. And I mean, the market, you can say that there were various things going on and various reasons why we collapsed, but the market absolutely did not like it. And I think that was compounded by him appearing on some interview then a week later where he said, no, I was actually telling you guys not to sell your BTC. I never said that I wouldn't do it, which is just, I mean, you can't write a script like that,
Right.
But it's an interesting one. So I think that, you see very, very strong opinions on the timeline, like, Saylor's an idiot. He's the one responsible for BTC trading so low, or lagging behind equities, lagging behind the rest of the market. And you see people saying, he's a genius. He knows what he's doing. I think the truth is somewhere in between. I think that he's made a lot of mistakes, but ultimately, I think I would be surprised if time didn't vindicate Michael Saylor.
It's the leverage is always, the thing that gets you, right? I mean, in the end, it's, having an over levered balance sheet. But when you think about it, I mean, given how much he owns and given how hard it is for an institution to establish its position in Bitcoin easily, you could imagine a scenario where if the stock started to trade at a reasonably significant discount to NAV, that you'd have institutions who are really interested, right? Because this is a way to get Bitcoin cheap, right? When he's selling stock at 3 times NAV to get cash to go buy Bitcoin, it's a terrible stock to own. And I think the idea that you can sustain that model forever is, it's probably seen that, time and time again how that fails. But when we start to trade at material discounts to NAV, you see this in shipping all the time, right? Or any asset heavy business, when companies trade at decent discounts to NAV, there are typically buyers. That's kind of how Buffett kind of made his business. Not to say he's coming in to buy here, but value investors will look at that. And so we'll see at some point if and when the stock does start trading at a pretty significant discount to NAV, even with all the leverage, you might get, big institutions who are looking. I mean, the market cap now is only $39 billion, right? I mean, assume it goes down another 30% from here. I mean, we're not really talking about a lot of money, right? And so if you're Fidelity or Blackstone or BlackRock is looking to kind of, up your position in Bitcoin, the asset class, it's not at some point this becomes, to your, hard to see it really becoming systemic to the asset class. Is the stock going to be? I have no idea, but as far as Bitcoin, the asset class, I kind of agree with you. I don't really see that. I think that ship has sailed.
100%. I think we just came to the end of the segment there, Craig. So thank you very much for joining me for the initial 15 minutes of this part of the show.
Absolutely, it was always fun hanging out with you. Enjoy the rest of it.
Absolutely, take it easy.
All right, brother. Take care.
And welcome. I think we have Trader Mercury on the call. Let me just see that happened correctly. Mercury, are you here? We can indeed. Yeah. How you doing, brother?
Man, it's good to talk to you, bro. I'm doing great. How are you?
I'm good, man. I'm good. I'm excited for this. You know already, but for those who don't, Mercury is one of my favorite traders in the space. We go back a long way, probably to 2021 or 2022, close to the start of my trading journey. So Merc has been a big part of my trading career and kind of my coming to terms with becoming a trader. So always a pleasure to talk to you, Mercury, and excited for the conversation we're going to have.
Yeah, man, it's like a proud father moment. I've been supporting you since the beginning, honestly. And yeah, I mean, you've just transitioned into like an amazing trader, and now you're on here teaching other people as well. And I get to come, hang out with you. It's really a beautiful thing.
Absolutely, man. Appreciate that. So I guess before we kick things off, maybe you can give people just a 1 or 2 minute overview of who you are and a little bit about your trading journey, how you got to where you are today.
Yeah, very quickly. I started trading crypto when I was about 17 or 18 years old. 18. November 2017, that whole rally, that's when I first got into it. And I made a lot of money very quickly, 4 or 5x my portfolio in the span of like 2 weeks, because that's how crazy that market cycle was. And I caught the, acceleration, part of it. And then I took absolutely no profit, and I drew down everything to negative 90% my initial. And I spent the next few years trying to figure it out. Basically, to sum up the story, I did incredibly well for myself because I put my head down. I spent 12 hours a day staring at the screens, trading markets, and I learned a lot in that time frame. And then March 2020 happened, and when you do very well for yourself for the course of 2 years, your ego gets very inflated. And then March 2020 happened, and I got humbled all over again. And so really that was the silver lining moment for me, where everything started to click. And I realized that, I was kind of just getting fooled by variance the entire way. And, winning for 2 years was kind of the worst thing that could have happened to me. So over the past 6 years or so, I've totally changed it around. I've done well for myself. I have basically just adhered to a trend trading mindset. This kind of thing where I'm not going to, disrespect the market, and oftentimes the market, is very kind to me because I take on that kind of perspective. So I respect trends. My system is very simple. I'm sure I'll get a chance to share my screens for everybody. My charts look very clean and clear. Moving averages, market structure, and horizontal levels, and that system has just generated lots of wealth for me over time, and I've been blessed to participate in markets.
That's awesome, man. Yeah, I mean, let's get into the charts. Maybe you can share, and we'll take things from there. Because I mean, for me, I always associate you first and foremost with trading moving averages, and it's such a it's such a pleasure to see how you analyze the markets and see how you execute your trades, because it's so very different to how I do so. So it's always nice to get that other perspective. But I think you kind of hit the nail on the head there. The way you analyze the markets, the way you practice your TA, it's very clean, it's very straightforward, it's very simple, right?
Yeah, it is very straightforward. Bruce Lee has a quote out there somewhere, and it says something along the lines of, "The height of cultivation is merely simplicity." And I don't know about you, man, but I had a weird infatuation with Blue. I thought he was the coolest dude ever, right? Uh, so that quote speaks a lot to me. It really does. And I can express a lot in very simple kind of perspectives. And the way that I break it down is I get a really good understanding for what the market is doing. And that allows me more freedoms from a discretionary standpoint when it comes to actually, executing. So I don't have to worry about necessarily trying to find the right signals to line up in such a way to tell me what kind of bias I need to have. In fact, my perspective is that a kindergartner could tell me what bias I need to have. And I think that this chart kind of exemplifies that pretty beautifully. Can you see my screen?
Absolutely, we can. Yeah, you're rolling.
Yeah, so these are just the 2-day 200 MA and 200 EMA. Very simple, very straightforward. And I know that you know me to be a moving average trader. The truth is that I define structure. So truly, I'm trying to get a good understanding for what the chart is doing. The reality is that the moving averages do not tell me anything that I don't already understand. So the entire epitome of my trend trading system is that even, a kindergartner would be able to tell me that this is an extended downtrend. And if I zoomed inwards onto a smaller time frame, they would be able to tell me that this is an uptrend. And similarly, they would be able to tell me that this is sideways, right? So that's the perspective. And then the whole idea is essentially trying to find the line of best fit that best and most efficiently represents what is happening, so that it becomes more tangible to my puny little brain. And all of a sudden, it becomes that much easier to actually go and put my hard-earned money on it and execute off of that idea. So these 2-day 200 moving averages, for example, have beautifully represented both, the bear market at times, the bull market from previous cycle, and the 3 years of very fruitful bull market that we had most recently. And then for the first time in 3 years, they were lost, in conjunction with breaking market structure, so making a lower low on a very significant time frame that we had not done before, putting in a lower high, losing a very key level. So this is a well-defined multi-month range of support, right? And so when we do all of those things in tandem with each other, at that point, that's where even a kindergartner would be able to tell me, this is probably not a market where you want to have too much exposure. You probably want to sit on the sideline. And if you run the risk of, because this actually did happen in the stock market, if you run the risk of a V reversal, then the reality is that there's still ample money to be made, right? Like your biggest fear is never the market is just going to go absolutely berserk and everything's going to run to infinity as best as it can, and I'm going to be sidelined for the rest of forever. Because quite honestly, that is exactly what happened to me on the stock market, and I've done very well for myself in that market as well, since then. So often, and actually, if we wanted to get into story time, my greatest trades have come off of me being blatantly wrong. So it's just kind of this like beautiful, humble perspective where I do not claim to know better than the market. And actually, Follis, what this has done for me is my most, big, like spectacular trade that I've had in the past 7 months on Bitcoin specifically is ironically buying the exact Pico bottom, where I was not respecting the trend for the first time in a very long time. But the only reason as to why I found myself in that position is because I was respecting the trend on the way into that. And George Soros, who is widely regarded as the greatest trend trader of all time, has a quote, something along the lines of, "If I believe the trend has been played out to excess, I may probe against it." So it's that beautiful, the semantics of that quote just speak out to me, so much, because it's so meticulous how he worded that. If I believe it's been played out to excess, then I may probe against it. So it's not like, I'm changing anybody's life by buying the bottom at 60K, but it's a very lucrative trade. And it's just that I have given myself that luxury to be able to dabble in that speculative venture because I had not been willing to do that for 6 months prior to that.
Yeah, I love that. Something you just said there that I want to expand on. You said that your best trades have come from you being wrong. What exactly do you mean by that?
Yeah, so my greatest trade of all time actually is the trade back here in September of 2024, just before the whole Trump presidency and that narrative, and all of a sudden crypto has the green light to perform incredibly well. So prior to this, I was incredibly bearish. But the reason as to why I was incredibly bearish is because if we zoomed out to the weekly time frame, we can see a subtle shift in the structure. Because again, I'm not really a moving average trader. These are pretty insignificant. They're just kind of vanity, right? They're telling me something that I already understand. If I'm assessing things from a structural standpoint, these are all higher highs and higher lows. Even this one, ironically enough, even though it's relatively equal, these are all higher highs and higher lows until we get right here. And all of a sudden, that is a lower high. So we can mark that one as red, right? To make it nice and clean for everybody. And ever since then, we start putting in lower lows and lower highs, right? And that's the perspective. When I see this trend shift and I can acknowledge this trend shift and say, hey, in hindsight, because obviously I'm the person that's respecting trends the entire way. So it's not like I'm expecting a lower high here. But in hindsight, once we start to show weakness on lower time frames, so if we were to zoom into a lower time frame trend, the representation, just roughly, it would look something along that line. And that's where we can start to see that weakness come in on a more actionable time frame that's more relevant to current day's price action. So in hindsight, that kind of allows me to say, the context now is different than what it has been the past year and a half. Now we're making lower highs. Maybe we make a lower low, and then we do. And so all of a sudden, now we are in a clear downtrend. And again, that's where the kindergartner could tell us that's a downtrend. You probably don't want to be in that, right? So then we continue lower high, lower low, lower high, lower low. So what is Mercury expecting here? Obviously a lower low, but that's not what happens. Instead, we get a higher low. We break that market structure bullishly once again. We then follow through with a higher high. We then retest a very key significant support level. If we were ever going to find a higher low, higher than that low, it's going to be here. This is my inflection point. This is the do or die kind of region. I know it's cringe to say that, but that's essentially how I'm thinking about it. And so from that point onward, after expecting a lower low and getting pleasantly surprised, that's where I get to take on a very heavy conviction, kind of a bias. And therefore, at this point, I'm sure you can attest to this as well, when you start to become more advanced, quote unquote, not every trade is created equal. When you see outsized opportunities that only get presented to you once every year, every 2 years, you're not going to trade them as if you're taking a trade that you see 18 times a week, right? So more position size, more confidence, more conviction. I actually got married during this price action. And I remember, actually, I think you might have been one of the people and a handful of other peers that were like, Mercury, you're on your honeymoon. Can you stop bull posting and go enjoy life? And I said something along the lines of, dude, I need you to lock in. Like, this is the opportunity where life becomes a vacation. So lock in, Bitcoin's going to run to the range highs and probably break out and go to new all-time highs. And I actually retired my parents off of that trade. So somewhere around $102,000 Bitcoin, I sold a good majority of that spot position that I had taken on with such heavy conviction. And I also took profit on a long-term investment bag of Bitcoin that I had for the past 7 years at that point. And I retired my parents. So it's just, again, the art of accepting that you're wrong and just respecting whatever the market is doing. And price is always the arbiter of truth, right?
That's crazy. Yeah, I've heard that story before, but it always gives me a little bit of goosebump to hear it again, man. It's just it's such a beautiful thing when you put your money where your mouth is, where your analysis matches your execution, and you're able to, turn a good read into something as profound and life-changing as retiring your parents. That's awesome, man. So I guess now that we know a little bit more about how you trade, what you look for in a chart, the next logical question is, what are you looking at in the BTC chart? Something that you said a few minutes ago was, any kind of kindergartner or any child can tell you from looking at the chart, the daily chart, that we're in a downtrend, right? And that's something. It's something that you told me years ago, and it's actually something that I always try and bear in mind when I'm analyzing market structure. Trying not to get caught up in the weeds of it. Like if you're zooming in and you're saying, "Oh, well, did this high break the low, and did we close below the?" No, I mean it should be immediately apparent whether we're going up, whether we're going down, or whether we're going sideways, right? I think that's something that a lot of traders get caught up on. So with that in mind, I mean, how are you viewing this BTC price action? I know a lot of guys are saying that it's choppy, difficult to trade. I haven't necessarily found it like that, but I'm curious to know how you've been getting on.
Yeah, so I always, you know me, Follis, I like my analogies. So my analogy here that I use, or my comparison, whatever you would like to call it, is the puzzle piece analogy. So the way that I break it down is, think about how you form a puzzle. And if you have a 1,000-piece puzzle, you don't just immediately grab 2 pieces and ask if they go together all willy-nilly. You start with framing the border, because those have flat edges. That's clearly going to be the outside of the puzzle. And from there, you color coordinate and you break it down. And all of a sudden, it's much more digestible, right? So from there, we can actually tackle it head on. So let's break down the context. Let's create the border, assess the environment, and then from there, we'll work our way in. Obviously, these 2-day 200s and therefore the kind of like monthly market structure represent that this is not a favorable environment. So we can just simply say we're in a bear market. Everybody knows that. Then we zoom in, right? We can go into something like the daily chart. It's going to tell us the exact same thing. The market structure, anything that you want to, interpret, pretty much the exact same thing. You can keep going, you can keep going. Essentially, the context, when we break it down, is just simply we are in a massive range. Right. So this is just a sideways environment. Again, even a kindergartner could understand that, same way that they understand this. And it's a massive range that's inside of an even more massive downtrend. That is not favorable context to me. That is not, hey, Mercury, stop touching grass, stop teaching your dog new tricks, come lock in, come participate in the markets with us, sell your bags of stocks and hyperliquid that are ripping into price discovery and come buy Bitcoin instead. That is not that signal at all whatsoever. That kind of directly goes against the entire, principle and philosophy of which that got me here to this point today in the first place. So I'm simply just not interested. I know that it's a really boring analysis to hear a trader, and oftentimes it's cope and complacency, and you know what, matter of fact, sometimes it very well is that. But I don't necessarily feel like that is a fair assumption or projection onto me at this point. This is exactly what allowed me, the luxury of buying everyone's capitulation at $60,000 Bitcoin. So I'm just sitting out. I don't really care to be trading underperforming assets. And, it's really as simple as that. And the reason as to why that is because I always tell people this: I really can't give you alpha. I can help you, I can help word things in a different manner that might make it click in somebody's brain. I might be able to, show somebody a system and they can do their best to copy it. But at the end of the day, it's going to require that discretion, that experience. The only true alpha that I could actually give somebody, especially a discretionary retail trader, is focus on strength. Relative strength is about as good as it's ever going to get. It is the only kind of edge that you're inherently going to give yourself as a retail trader. And it's the only place where you have skewed the probabilities in your favor of actually doing well. So it's funny because it's like, I love Bitcoin, I really do, but I hate the chart. I'm not going to trade this. I'm not going to force positions. But then when we go talk about hyperliquid, I've done exceptionally well for myself over there. And when you go, I know this is not a hyperliquid segment, but when you just simply compare, and again, even a 4-year-old, right? It's just that simple. Where am I going to put my attention? Because where are other people more likely to put their attention, right? People are so hell-bent on fading crowds, but don't realize that if they want their thesis doom or amazing manic bull market, if they want their thesis to come true, you require the crowd. So what is exactly going to attract the attention of the crowd? People talking about a particular asset. Why would people talk about a particular asset? Because it's going up. Right. So that's where things become consensus. And all of a sudden now you're hearing every single crypto trader discuss about, how stocks are so much more fun Why is that? They wouldn't be saying that if stocks were going down, just the same as Bitcoin, right? It would just be doom and gloom, like 2022 all over again. So attention, the market is an attention economy. Where am I going to put my attention? And therefore, what warrants me putting my capital? If I don't even want to put my attention on something, why would I put my capital on it?
Yeah, 100%. And that hyperliquid chart is beautiful. It's such a good illustration of a point that I have been making on this show very frequently recently, which is, try not to get caught up in this idea that just because an alt is down 80 or 90%, or just because it's down 60% in a month, that it's got to bounce, that it's got to give you that mean reversion. Like, I'll show you my chart here. This is the LIT chart, which is actually a chart that we looked at last week. And it's a kind of a beautiful illustration of the point you just made about avoiding, trying to avoid putting your capital in the coin that's not performing, right? We had this chart that was just in an obvious downtrend for months. Then we had this really nice consolidation at the low. And then what did we get at the start of May? This big move up that broke structure, right? You spoke about structure. It should be clear and obvious. This is obviously a downtrend, obviously a range. And then this is the beginning of what it was to become an obvious uptrend. But if you were hammering in longs this whole way down, you would have just been bleeding capital. Whereas the smart patient trader waited to see that initial strength before getting involved. And I think that, yeah, it's something that traders, I see advanced traders just as much as beginner traders fall foul of this fundamental simplicity of the markets, which is that, you shouldn't be fading strength. You shouldn't be longing into a downtrend. You shouldn't be expecting a bounce every time the market drops, because that's just not how markets work, especially when it comes to altcoins.
Yeah, and you know what? It's such a simple concept that it almost doesn't feel real that you'd be able to translate it into tangible profit. It doesn't feel real that when you see hyperliquid breaking out of a clear multi-month range and reclaiming very significant trends for the first time in a long time, and it just sold off -70, -80% off the highs, that as Bitcoin is chopping sideways or downtrending even, that you're going to be able to apply something as stupidly simple as, I'm just going to put my money where other people will probably put their money, and then make a ton of money off of that idea, right? But again, if you thought that way 5 months ago, 6 months ago, then you missed out on a 200% move on hyperliquid. And it was, again, glaringly obvious. Even a kindergartner could have, expressed that concept to you. But it's a totally different beast when it comes to actually being able to execute that concept and put your hard-earned money on it. And again, that is also the incentive to avoid these downtrends and not give so much of my mental capital to the market when it doesn't deserve it. It doesn't warrant it.
100%.
And at this point, I can speak to this honestly. I've almost traded crypto for almost 9 years at this point, and burnout is definitely a real thing. So if you're going to go just as hard in the upside and just as hard in the downside, all props to you, because I can't do that, right? I have a family, I have a life, I want to have kids one day. I just bought a house. I'm trying to actually enjoy this life and make the most out of it and mentally recoup. And I'm not getting traumatized on the way down, and I'm not losing confidence and losing courage, in my system or in my abilities. And at the same time, I'm preserving that capital. And there's no amount of words that can possibly explain how much of an edge that is compared to presumably 95% of retail traders out there.
100%. I want to come back to the hyperliquid chart, but first I just want to finish up with BTC. You mentioned how you're not particularly interested in trading this price action, which is totally fair, and I completely understand. I guess one of the contextual things that people should be aware of before you answer this question is you don't short the market, and maybe that's something you can get into in a little bit more detail. But what do you need to see, therefore, from the market? What do you need to see from the Bitcoin chart in particular in order for you to flip from not interested to interested?
Yeah, so I need to either see one of two things. It's very simple. I need to see complete capitulation, peak fear, the same way that I saw at 60K. The issue with that, and again, 8 years of trading experience, it's not that I'm afraid to bid in the middle of a capitulation candlestick. It's that it's really difficult to explain to somebody in words what it feels like and what it looks like to go about doing that. But because of this trade that I have taken, and truthfully, I've gone and back tested this on Bitcoin itself, there's maybe 3 times in the past 4 years where I would have actually taken on a similar trade to such as that, capitulation candle in February. The best way that I can describe this is you're going to wait for your tier 1 crypto exchange to start blinking rapidly where, all of a sudden price is gapping a couple percentages in the millisecond, right? Like the next, tick of that price action is 1, 2, 3% different than the tick prior, and only a millisecond has gone by. That's the point where all of a sudden liquidity has just gotten absolutely, destroyed, and it makes sense to start coming in and providing liquidity to the market in exchange for hopefully some kind of mean reversion. Other than that, I am just not interested. There's a massive difference between, this candlestick and this sell-off, and in my opinion, in my discretionary, gauging, this candlestick and this sell-off. And I don't necessarily know how to explain that to anybody, but this is a normal Tuesday afternoon. This is a once a year kind of opportunity. I don't know how to phrase that necessarily, but that is obviously one of the things that I'm looking for in a substantial downtrend, because you're right, I don't short markets. The other thing that I'd be looking for is simply strength. So essentially the way that my system works is I'm just going to wait for breakouts. I'm going to wait for inflection points to get flipped. I'm going to wait for higher highs. I'm going to wait for a reclaim of moving averages. And hopefully I'm getting all of those things in tandem with each other. In this case, that is exactly what I got. At the time, I was using these 12-hour 200s, mostly because of how they represent the market most recently up until that point, and also because of how well they were respected historically. Again, this is just gauging. It's just more tangible to my brain. I already knew that we were in a downtrend without these moving averages, right? But they helped me understand both the downtrend for 6 months prior and the fact that we're breaking out of a key level for the first time in 2 months, and that we're reclaiming a trend that we had not been able to reclaim for the first time in 6 months. To me, that means something more significant has happened. Strength, right? For the first time in a long time. Notice how we contextualize it. We discussed the amplitude of the volatility. We saw a -40, -45% sell-off below these moving averages, and we saw a 6-month downtrend. That is context. So to me, that means we should be able to muster up enough courage and enough fuel to at least get us into a relief rally of whatever the next, key level is. In this case, we didn't quite do that. So we lost that strength all over again, but nonetheless, that is the trigger. Variance is variance. Short-term things are short-term things, but, in the long term, as long as I continue with consistent, accurate signals that I feel confident in, that are both back-tested and forward-tested through experience, I'm going to be just fine. So I'm just waiting for strength. At this point, I've kind of moved the goalpost a little bit because the 12-hour 200s kind of just got disrespected and didn't really care. We saw a whopping 10% movement, after reclaiming them for the first time in 6 months. But in hindsight, and this is beautiful, hindsight has a luxury not to sulk. In hindsight, the 200 daily moving averages were beautifully respected as the top, pretty much. So now moving forward, essentially, I'm looking for the same, if not similar trigger, where 200 daily moving averages are getting reclaimed, and we're breaking out of this range once again. And that's going to be a strength signal. And again, we have to contextualize this. This is the convolution, the overcomplication, and therefore the disappeal to Bitcoin trading specifically. Because even when I see strength, I still have to talk about the fact that I'm purely exclusively looking for a bear market relief rally before presumably we find yet another lower high and resume the downtrend all over again. At that point, that's where it just makes so much more sense to just simply go trade hyperliquid.
Yeah, I love that. It's something that I always speak about. We're not trying to predict what price is going to do. We are not fortune tellers. We are not psychics. Your job as a trader is not to try and time these market bottoms to perfection. Your job is to wait for the market to show you that it's bottoming and then react based on that information, right? As you say there, you got to wait for the market to give you a bit of strength and then you become interested. You're not interested in the market if it's just, well, at least you're not interested in longing the market if it's just continuously trading lower and putting in lower highs, lower lows. And the structure is just telling you that, the next impulse is going to be an impulse down. But when that starts to change, that's when you need to start sitting up and paying attention, right? And that's when you need to start playing to your strengths, which is waiting for that confirmation to happen and then executing based on your analysis. I want to quickly touch on the hyperliquid chart because this is obviously something that everyone in crypto is talking about. It was probably or arguably the trade of the first half of 2026. So I'm just curious. I mean, I know a lot of guys in my circle who are looking at this thing now and they're saying, okay, we're getting a double top here. We swept the previous all-time high. This thing looks a little bit toppy. Looks like we might be pulling back, not the cycle top or anything, but maybe pulling back into the 40s. What's your take on that?
So again, I'm just going to respect the trend. The way that I have managed to trade hyperliquid is I initially bought this breakout. I did well on that breakout. That's a 50% move or so. I had a trade drawn up. Follis, how many times do you hear that? I had it drawn up. I planned on taking it, but I didn't take it. So I got sidelined here, and then I missed this entire part of the rally. And I managed to position on this one. So I did well for myself. And I held this position entirely up until somewhere around like $65 or $66. Most recently, I've re-entered hyperliquid a little bit allocation around these lows, and then more further allocation around just under 60. So I have a pretty good entry currently in profit. Hopefully I'm not jinxing myself. And I'm just going to continue respecting the trend. I've micromanaged the trade to somewhat of an extent. So I've taken a little bit of profit. When I say taken off a little bit of profit, I've scraped off profit because these are I don't know how much time we have, but essentially I abide by what's called the Pareto principle, which is the 20-80 rule. And so essentially it works like this. 80% of the time that I'm watching the market and giving it my time and taking trades, I'm going to extract probably only 20% of the wealth that I'm ever going to extract from that market. The other 20% of the time accounts for the remaining 80% of the reward that I extract from markets. So that is just simply to say that markets chop and downtrend more frequently than they go on parabolic uptrends into price discovery. So when they do that, it's my job, especially as somebody who's curated their entire system around ensuring that they perform when these kinds of moves happen. It's my job to allow that move to hard carry my portfolio. If I'm being blatantly honest here, my win rate the past 4 months is incredibly poor. I want to say it's probably close to 30%, if I'm being honest. My portfolio is looking really damn good. So it's just the fact of the matter is I need to let performers outperform. I need to let them do their thing. So I'm not looking at this as a double top, because my argument that I like to make is that if somebody's willing to call this a double top, wouldn't they have said that here too? Wouldn't they have said that there too? Wouldn't they have said that here? Wouldn't they have said, hey, we swept the highs, we swept the liquidity and closed back below? Wouldn't they have said at some point during these rallies, wouldn't they have said that we swept the high over here and that this is a massive range and now we're going to deviate back inside? Wouldn't they have said that? Probably, right? And it's so funny to me because the people that aren't saying that are the people with .hl at the end of their name. So they're just going to bag hold to infinity and all the way back down to zero anyways. So they're insignificant, right? I need to be somewhere in between. I need to be reminding myself that gravity exists, but at the same time, if the moon boys are right, then I want to ride that rocket ship right alongside them. And that's where the market does most of the heavy lifting for me. So right now I'm sitting pretty. I'm allowing this to do whatever it wants to do. I know very well that the trend is eventually going to get exhausted. Either it's going to get chopped up and move sideways, or we're going to top out entirely. But it's not my job to predict what's going to happen next, like you just said. And it's not my job to go searching for reasons as to why I might be wrong. It's the market's job to prove me wrong. The market needs to tell me, hey, Mercury, I know that you had fun riding this trend for 150% out of this 200% rally, but it's over, right? You don't get to have any more fun. That was it. And then I get to whatever profit I've managed to maintain at that point. that's what I'm left with. And that's that haircut that you take off the top. You're never going to lock in your most recent new all-time high net worth, but hopefully the next time that it happens, you make a higher high and we just keep the ball rolling.
Yeah, for sure. So just firstly, we're good for time if you're good for time. If you're happy to stay on until the end of the segment, I'm more than happy to chat with you. Would be my pleasure. But no pressure. Completely up to you.
Man, you know, I love to yap. You know me.
There we go. I knew that would be the answer to that question. I just wanted to be polite. But the second thing I want to touch on there is you mentioned having a 30% win rate. And I think this is a really instructive lesson for, let's say if there's any beginner traders in our audience who might be thinking like, wow, that's too low. Like that could never be profitable. Win rate has to be the most overrated metric in all of trading. And it is somehow people conflate it to profitability. Win rate is just one factor when it comes to profitability, and it's not even the most important factor, right? Let's say you're running a trading system and you have like a year, you have 12 months of data running this trading system, and you know that your win rate is 60%, right? You know that for a fact. You know that if you take enough trades over enough period of time, you're going to win 60% of those trades. The 40% of those trades that you lose, are they failures? Is it something wrong with your system? No. That's the price of admission for running that profitable system. That's the price you have to pay in order to run that system to its full extent and in order to make money from the market by running that system. But I think that a lot of guys, because we're humans after all, right? So we start trading and we take a few losses and we conflate that with failure, right? Or we equate that to failure, because losing for most of life's, you know, vocations and professions and pastimes, losing is failure. But in trading, losing is just a part of winning, right? And it's like a weird thing that you have to get in your head as a new trader. Like losing 40% of your trades might just be the price of running a profitable system. So when people hear Mercury saying, oh, my win rate was only 30%, but my portfolio has never looked better, some people might go, how can that be true? Or that doesn't make any sense. But to me, that makes perfect sense, because sometimes you just hit variance and you just hit a bad streak, but you know that the positive expectancy of your system is such that eventually you're going to find your feet, eventually you're going to get back to your winning ways, and eventually you're going to come out on top given enough time, right?
Exactly. And just this is how I forced myself, because the reality is I'm not the most stoic person in the world, right? I'm not Marcus Aurelius. So I have to force myself into thinking this way, because I'm human at the end of the day. But the way that I've forced myself to think about it is, wow, I've had pocket aces quite a few times and they've gotten cracked nonetheless, right? Quite literally the best hand that you can have in poker. So I'm taking good trades. I've obviously been very picky and very strict with what kinds of trades that I've taken, but they just didn't always play out the way that I wanted them to. And yet my portfolio still looks amazing in the past amount of variance, where I probably only have about a 30% win rate. So I forced myself to look at it as, wow, how would my portfolio look if only another 3, 4, 5 of those trades actually managed to do what I thought they would do? And would just look that much better, right? And that's the kind of like everlasting dream that keeps you want to keep, makes you want to keep going and chasing the next new all-time high. Is like, man, I could do even better than this. And yeah, and that's how you kind of just get infatuated with markets. But yeah, it's just simply risk management. It's knowing and playing the variance aspect and learning how to be disciplined and stoic enough to be able to stomach something like that. The thought experiment, I guess it's not a thought experiment, it's math. But the thing that I like to remind myself of is, if you flipped a coin, let's say 10 times, you might experience, 8 heads and 2 tails. But if you flipped it 100 times, you'd get closer to that 50% benchmark. But if you flipped it 1,000 times, you get even closer. I don't know. Math is just phenomenal, man, right? Like if you flipped it 1,000,000 times, it might be exactly on the dot, 50-50. But if you ask ChatGPT, for example, and you say, hey, how many times out of those 1,000 coin flips did we see heads or tails in a row? 8 times in a row. It might tell you up to 20 times that happened. So if you're in the middle of that variance and you're experiencing heads 8 times in a row, and you know that eventually over time it's going to balance out through 50-50, but it's not necessarily math, so you can't quantify it. It's not something you can believe in. It's something that you have to force yourself to believe in. It's a theory, it's a concept, right? When it's something like that, that's where we start to slip up. That's where we start to forget that it's a system-based kind of way of going about the market. It's very strategic, and it's chess, right? And I actually know that you're an amazing chess player.
You flatter me. But I mean, that's why risk management is so important, right? We always talk about risk management. We should be risk managers first. Man, if your system can't withstand 8 losses in a row, to your example, then it's not a good risk managed system. And a lot of people, as I said before, a lot of people will get into trading and they'll start running a strategy and they'll experience like their first 4 trades will be losses, and then they'll go, no, my system is shit, there must be something wrong with it, and they'll jump to the next thing. But that's just variance. That's just how trading works. I want to look quickly, because we only have a few minutes left. Are you looking at any other alts? I know we spoke about Hyperliquid. Are there any other altcoins on your watch list at the moment, Mercury?
Oh man, I really don't think so. I've been very passive about the market. Let's see how INJ is shaping up. So something like this is where I would be looking for mostly like a trigger trade. This chart should be drawn up already. Let me see if I can find a better one. So this is something where the context is there. It might shape up in such a manner to where I'm actually inclined to want to trade it, but it's not quite executable just yet. So the context is there in the sense that, again, if you look at this chart, anybody can say, wow, this has crazy potential, right? If you look at the other bits of variance, this is what I would say is only a 60% move. This is the next bit of variance is only a 35% move. The fact of the matter is, when I see this kind of a trigger and this kind of a contextual reclaim for this severe of an uptrend, I am not looking for a measly 35% or a measly 60%. So this is crypto. This is a blessing. This is where we get to remind ourselves that this is crypto and crazy stuff happens, where we can say we scoff at the market because it only gave us 30 or 60%, right? We wanted much more than that. Currently, we're in that same kind of basket where this thing has the potential to run incredibly hard, but there's not really a great way for me to take action based off of that concept right here and right now. Even more so, it never feels comfortable to step in front of trains, especially when sentiment is very, piss poor, for lack of a better phrase, and momentum has just not really been established on anything besides maybe a handful of coins at best, right? Probably more closer to just 2 or 3 at best. So it never feels comfy to step in front of the train and bid a broad and vague inflection point. Like Follis, I would never say to you, hey, just bid somewhere in this 30% region and hopefully maybe 6 months from now, you'll be able to sell for profit, right? That's not a good trade. So the way that I would look to execute this is by zooming into a more actionable time frame. This is what where the puzzle piece analogy comes in. And I would look for more actionable strength and momentum that abides by the context that I've already been able to assess and observe on a higher time frame perspective. And I would look for a trigger via the reclaim of this inflection point, and all of a sudden that would be the kind of thing that makes me want to participate in this market. There's a lot of these out there in the crypto market right now. There's a lot more of coins that are just simply making lower lows or chopping inside of ranges the same way they have been for the past however many months at this point. But there's an abundance of these coins, right? Probably a few dozens out there in the market. This was just one kind of blueprint. Think of it in that example.
Yeah, I really like that. I'm going to quickly show my screen. I just want to show this chart VVV. This is actually an alt that we looked at last week. And I think you'll see here, it's shaping up. This is actually one that Ponzi mentioned. He said that this is shaping up as a distributive top and potentially a great short. I really like this. And I was looking at it after our stream. It really, to me, looks like this kind of 3 drive type price action followed by distribution. I would love to see us lose this low time frame range here and start kind of retesting the range low as a bearish retest. The reason I say that this looks distributive, you guys know I love my accumulation versus distribution schematic. I speak about this all the time. Who is in control, buyers or sellers? To me, it looks like sellers are taking control here. Buyers are stepping out. I think we even see that here with the CVD. Spot CVD going down. Spot is selling while perps is keeping price propped up to some degree. I think this will be a very nice short at some point soon. VVV, obviously it had a pop recently because of the AI narrative. So it is a narrative coin, be careful, but I think that there will be a very nice short here soon. We have about a minute left, Mercury. So as we do with all our guests, I'm going to give you 30 seconds to answer this one. You need to tell me where BTC bottoms, what price, even though we just said we're not psychics. I want you to be a psychic for 30 seconds. Tell me where BTC bottoms, and why.
31,324.98. And that's just a number I made up, but around 30,000 is the next kind of like weekly support level. So the thing that, I kind of touched on this earlier, this sell-off is a normal Tuesday afternoon. This sell-off is a once in a year opportunity. The thing that kind of separated that is a lot of context. Bit of that context was capitulating directly into a weekly support level. So if we're able to capitulate into a weekly support level, that's going to be the best place, if ever, to bottom out, for buyers to finally step in, for price to finally go sideways and develop momentum eventually to start trending upwards. It's just the next weekly support. So I'm hoping that if it's not this weekly support, it's the next weekly support. And then, I'm hoping that'll be the bottom at worst. So we'll see.
I love that. Someone who's targeting an even lower number than I am. Mercury, we're coming to the end of the show. So I just want to say a massive, massive thank you to Trader Mercury. He's one of my favorite guys in the space. Mercury, where can we find you? On X, presumably, and YouTube, right?
Yeah, X and YouTube. I'm just simply at Trader Mercury.
That's great, man. I'll share your handle in the chat as well. And that's it, guys. We have come to the end of the show. This was the Crypto Closeout with Kraken Pro and NinjaTrader. Thank you very much for joining us. And once more, thank you to our very special guest, Trader Mercury. It's always a pleasure, Mercury. Thanks for joining us.
Always a pleasure, man. Thank you.
All right, guys. We will see you next week for the next Crypto Closeout. Until then, try not to get liquidated, and we'll see you next time. Bye-bye.
Peace.